In this video, we are going to talk about preparing the operating section of the statement of cash flows using the direct method. Now, we're only talking about the operating section because whether you're using the direct method or the indirect method, the investing and the financing section are going to be done the same. If you remember back to the indirect method, we predominantly used our balance sheet. We looked at the pluses and minuses for our assets, liabilities, and equity, and then we only referred to the income statement to look for depreciation expense and gains or losses from the sale of our long-term assets. We are going to predominantly use the income statement for the preparation of the direct method, but we are not going to adjust for depreciation using the direct method. Similarly, we are also not going to adjust for the gain or loss on the sale of land. So what we're going to basically do is we are, again, looking at this from an income statement perspective, and we're going to convert our accrual-based income statement to basically what would be a cash-based income statement. And so we're going to adjust the sales to what was really cash received from customers. We're going to adjust cost of goods sold to cash payments for merchandise. Then we're ignoring depreciation in terms of expenses, but then we're going to convert all of our other operating expenses to what we actually paid out in cash for operating expenses. We're ignoring gain or loss on sale of land, and then we're looking at the interest expense that was accrued versus what we actually paid for cash. Same thing for income taxes. And that gets us from an accrual-based net income to a cash-based net income from operating activities or cash-based income statement. So I'm going to hop back to the income statement from the Rundell Company, which we used in the lesson on the direct method. But we had sales of $1,180,000. And so we now have to first figure out how much of those sales did customers actually pay us for in cash. And so here we are back at the Rundell Company, and so here are where we're getting the figures that we are about to use when computing this statement of cash flows. So now we need to figure out, how do we convert our sales that we reported on the income statement to actual cash that we got from customers? Well, back on our balance sheet, when we looked at the indirect method, and I don't want to jump back there because it's getting a little unwieldy here, but we determined that there was either an increase or a decrease in our accounts receivable. If you have a decrease in accounts receivable, you are going to add that to your sales figure. If instead your accounts receivable went up, you're going to subtract that from your sales figure, and that's going to get you your cash received from customers. And so in this case, we had an increase of $9,000 in our accounts receivable. So we subtracted that. And so if you think about it, if our accounts receivable went up, that's people who owe us money. So we collected less cash. So we're going to subtract the cash we didn't collect, that difference, from our sales figure. Now we're going to look at our cost of goods sold and look at what we paid for merchandise. Now back to the income statement. Hopefully I won't jump back there, but you remembered the cost of goods sold is $790,000. We now have to convert that to our cash, and we are going to use, this is a two-step process. Our inventory either went up or it went down. If the inventory went up, that's going to be, we're going to add that to cost of goods sold. If the inventory went down, we're going to subtract that. Then our accounts payable. If it went down, we're going to add it. If it went up, we're going to subtract it. So this is different in terms of how you treat the asset versus the liability with the cost of goods sold than we've done on any of the other ones examples, because in cost of goods sold, the assets get treated in the same direction as the sign versus the liabilities, which now get treated in the opposite of their increase or decrease. And hopefully I'm not making this more confusing. But we had a decrease in our inventory, and so we're going to subtract that from our cost of goods sold, and our accounts payable went down. That gets added back in. We have cash payments from merchandise, I should say, of $785,200. And that's how we adjust our cost of goods sold to what we actually paid for our merchandise. And I'm not going to just reiterate what's on this slide. Now we get to cash paid for operating expenses. Now, we had total operating expenses of $203,000, which includes depreciation. So we need to back that out of there, and we need to deduct the $7,000 from the total expenses because we're not going to treat the depreciation in our operating section. So we're really going to start with operating expenses of $196,000. So now to get the cash that we actually paid for expenses, we go back to our balance sheet and we say, okay, did we have an increase or a decrease in our prepaid expenses? And so if we had an increase, we add that to the operating expenses, which we have adjusted for depreciation. If we had a decrease, we subtract them. The opposite applies for the accrued expenses payable. If those decreased, we add those. If they decreased, we subtract them. And from there, that gives us the cash we actually paid for our operating expenses. So we start with the $196,000. We had an increase in accrued expenses payable of $2,200, so we subtract that, and that gets us to $193,800. Now, gains or loss on the sale of land. Again, this is an investing activity, so we are, for the direct method, not going to report that in the operating section. We now need to look at interest expense. And you say, well, why isn't interest expense already dealt with in there? Because that was not part of the operating expenses. So we've got to adjust for our interest expense. And the way that we do that is we take the interest expense that's reported on the income statement, and we take a look at the interest expense on our balance sheet, and if our interest payable went down, we add that to the interest expense reported on our income statement. On the other hand, if the interest payable went up, we're going to subtract that, and that tells us how much cash we actually paid for interest. Now, with our actual example of the Rendell Company, we did not have any interest payable, so we don't have to make an adjustment of the interest expense. The last thing we need to do is report the or make the adjustment for income taxes. So we reported on our income statement a tax expense of $83,000. We now need to figure out what we paid in actuality for those income taxes. And we do that by adjusting the income tax expense by the payable amount. So we've got our income tax expense that we reported on our income statement, if we had a decrease in income taxes payable, we would add that. If we had an increase, we would subtract it, and that would get us our cash payment for income taxes. In this case, we had a $500 decrease in income taxes payable, so we added that to the income tax expense to get our cash payment for income taxes of $83,500. Now this shows, using the direct method, this part up here in blue, how our operating section appears as a result of the use of the direct method. Now note that if you remember back to the lesson on the indirect method, the cash flow from operating activities is still $100,500. So regardless of the method we use, we still arrive at the same number in terms of cash flow from operating activities. And then we can continue to go down and do the same sort of reconciliation by adding or subtracting the investing and financing. The different thing that we need to do now, though, with the direct method that we did not have to do with the indirect method, is we need to do a reconciliation now. As basically this is going to look like your direct method. So we need to show, or excuse me, like your indirect method. So we need to show at the bottom here, and if you use the direct method, this reconciliation is actually required. So while GAAP wants you to use the direct method, they also want the indirect methodology reflected on your statement of cash flows to show how that income statement was, or your net income, I should say, was reconciled to get to your net cash flow from operating. And in fact, they are the same. And if this was confusing, I'm sorry, you are not alone. This is a really confusing topic, and you may now see why the indirect method is a preferred method. If you prefer the direct method and you find this cleaner and more intuitive, I'd love to hear from you. And that concludes Chapter 15 on the indirect or the direct method.